Guys, Netflix just announced, and they have crushed it. They are currently up 7.5% after hours, a few minutes past. I'm going to pull up their actual report. Guys, this is their actual shareholder letter. This is directly from their website. I just pulled it up minutes ago. So, reported revenue of $7.9 billion versus last year's $7.483, which is an increase of about 5.9%. Net income of $1.398 billion versus $1.449. But here's the big key. They were expected to earn low $2 per share in profit. They reported $3.10. That's why they're up so much after hours. Now, global streaming memberships, 223 versus 213, and versus last quarter at 220. So very little growth, but that's okay for right here. They're expecting another 4 million subscribers here. Free cash flow, $472 million versus a loss of 106, and shares outstanding down slightly. So they crushed it. Let's see how much more the stock is up now. They're at 10% now, just like that, guys. So the question is, what's it worth? Now, guys, I want you everybody to remember here. Look at this little number right here. That's the 52-week high on Netflix, $700 per share. Please do me a favor. At the end of this video, I want you to go back and look at our videos about Netflix. How we talked about it wasn't worth $700, etc. Paul, you're crazy. There's no way it's going to fall. It got as low as $162 during this crash. During this crash, $162. That is a fall of how much? 75%? That's incredible. You've got to remember that overvaluation valuation drives returns over long periods of time. Eventually, valuation matters, and it matters with a vengeance, as John Hussman says. When it does matter, it matters with a vengeance. And when everybody is in the crowded theater and the fire hits, everybody wants out the side of the door, the one door, and everybody thinks they're going to be the one to get out of it, and it doesn't work out that way. So let's look at Netflix and determine what we're going to do here. 8 pillars. All right, at least they're buying back shares. I mean, I don't like they're buying back shares. Look at this. Negative cash flow. They have negative free cash flow in the last 5 years. Yes, it's grown $2 billion, but it's still negative. So let's go to their cash flow statement right now and just look at this. Now they're up 10.5%. Yeah, so they just turned it in positive free cash flow. But look, 5 years. I mean, this is a tough business. Now, does that mean Netflix isn't worth it? I mean, at some point, it's going to be worth it. At some point, they're coming out with a new ads version that's going to be cheaper. But for me, I'm just going to keep I don't like ads. So I look at the stuff saying, okay, balance sheet. They have no 5-year cash flow. Their 5-year PE is 38.8. We want it to be 22. Return on invested capital is going to be negative because they have negative cash flow the last 5 years. This is a company that's still investing back in itself. But now, like Uber, I think they realize, oh my gosh, cash flow matters now. The market has shifted. People want to see cash flow. And that's where we stand here today. So let's look what analysts are saying about the company. They're expecting $10 per share in profit, growing to 17 in the next 5 years, which is pretty decent growth. 70% increase in 5 years. It's roughly 13, 14, 15%. Not bad. Now, if you apply a 20 multiple to this, that's still $205. Apply 20 multiple to this, you're at 340. The question becomes, why are you applying 20 multiple to these things? This is not a fast-growing company anymore. The growth is gone now. I mean, how do you possibly grow when you have 230 million users? Look at the revenue growth. Look at this, guys. Single digits. This is single-digit revenue growth. It's no longer the days of getting double-digit revenue growth all the time. There's a lot of analysts following this thing. So that's what you got to remember. Eventually, the growth story stops. Eventually, people care about valuation. Eventually, people care about cash flow. How am I going to get a return on my money when the hype train stops? And the hype train has stopped for Netflix. Doesn't mean it's not a good investment. It just means now the investment matters based on the cash flow and the multiple you pay for cash flow. Very simple. But I talk about that all the time on this channel. Over and over and over again, my goal is to buy good cash flowing businesses for a good price. Netflix at $260 is still better than $700, but the question is it good enough? Don't be fooled to think that just because the stock has fallen 70%, it means it's a good deal. Not at all. The analogy I always give, if you have a home that's worth $1 million and you ask $10 million for it and nobody buys it, drop to $5 million. Is it suddenly on sale? Well, theoretically, but is it a good value? No, it's still only $1 million home that you're asking $5 million for. That's the important part. So let's use our stock analyzer tool and determine what we want to pay for Netflix based on a 10-year analysis. Now remember, the 5-year analysis, the 5-year estimates for revenue growth is single digits. So on 10 years, I want to go a little bit lower than that. So I'm going to go 3, 6, and 9%. Profit margin. I do think the profit margin can get better. Their gross margin overall is 40%. They did 16% in the last year. So I'm going to go with 13, 16, and 19%. And for free cash flow, I'm going to go 8, 11, and 14. Now, over long periods of time, free cash flow should be equal to earnings. But they're investing a lot back, so I think they're going to keep increasing that. Now, one thing I want to keep in mind, guys, I'm showing free cash flow numbers that are very, very high compared to what they're showing here. So just remember that when we see our free cash flow estimate of value. PE. Now, guys, growth is really slowed. It's going to be a bigger and bigger company, and there's a lot of competition. So you've got to factor that all in here. I'm going to go with 13, 14, and actually, you know what? I'm going to do 14, 15, and 16 PE and price of free cash flow. Because, guys, very competitive. Is it the leader right now? Absolutely. But I have like 8 streaming services. And I have Disney, I have Hulu, I have Peacock, I have Netflix. To me, I was paying $150 for cable. Now for all my streaming services, I pay like $110. So to me, I'm getting even more for less. That's my view of this. So there's a lot of competition out there. The question is everybody going to be like me and look at it that way? It's a business that they keep creating more and more content to compete. So that's going to suck out their free cash flow. Now, desired return. As you know, you can get 9 or 10% in the long run by buying a low-cost ETF. So to buy an individual company with these kind of growth parameters, you need to put some sort of margin of safety in here for your desired return. And the higher your assumptions, the greater your margin of safety, because you need to pay less money for the company because it's less likely these things hit. So for Netflix, I'll do 12, 14, and 16% returns. The company is currently at $272 a share. It's now up 11% after hours. 11%. It's up $27. All right. Boom. All right, guys, let's focus on earnings. 112 to 206, middle price of 150. So it was pretty close to our middle price when it hit its low of 160. So I'm going to add it to my watch list at 180. And the reason being is I want to start doing more research when it hits 180. Are my assumptions correct? Go understand the business more and then start selling puts on it based on those prices. Please subscribe to the channel. We do a lot of videos like this, 2 or 3 a day. You're going to love it. 1,800 videos. Talk to you later.